Hello guys, welcome back to my channel. This is Gideon Forex Academy. If you haven't subscribed, consider subscribing to this channel as I bring you valuable content like this every week. So today we have a very basic lesson and I'm covering the full course, a full understanding of what market structure is all about. We are going to cover all the components of market structure, including support and resistance and all of that jargon you normally hear people talking about when they talk about market structure. This course is a full comprehensive course and it is very good it is simplified for intermediate and new beginner traders. Just watch this video till the end. If you haven't subscribed, consider subscribing to this channel and also like this video. Share with like-minded forex traders. If you don't understand market structure, it's going to be difficult for you to trade. You are going to make mistakes. You are going to enter trades when you are not supposed to enter trades. You are going to make so many mistakes. Understanding market structure is a fundamental, it's a foundation of understanding how the market behaves, the characteristics of the general market and price action. Okay, the technicalities involved, all the technical analysis are based on this fundamental understanding of what market structure is all about. So we are going to look at market structure and all of its components, support, resistance, pivot levels, supply and demand, and all of that in this full course. It's going to be short course, but when you watch it and listen carefully, don't mind the jargon, the confusing jargon out there concerning market structure definitions. Market structure is basically the direction of the market, the general dominant direction of the market, depending on which time frame you are in. If you're in a 4-hour time frame, the dominant trend is the market structure. It's just the direction of the market, where the price action is going. Let's say the market is bullish. Okay, it's creating this impulse and correction. There's an impulse and then there's a correction move. There's an impulse move and a correction move. There's an impulse and a correction. All right. Each time the market creates higher highs, like in this case, okay, in the bullish market structure, there has to be a break of structure to the upside. As you can see here, there was a break of structure here. Okay. There was a break of structure over there. And there was a break of structure over here. So this is what we call BOS. You might have heard of that acronym, BOS. So BOS stands for break of market structure. And as you can see, it happened here. There was a break here above. So there was a break here of the structure to the upside, okay, with that impulse leg. So we have a BOS here and we have BOS there. We have BOS there as the price rallies all the way to the upside. So that must happen in a bullish market structure. All right, there has to be higher highs, like in this case, this is a higher high. Okay, that's a higher high, that's a higher price. It's actually higher than this previous higher high. Okay, and the next one is also higher than the previous one. This one is higher than this one, all right? And also the price creates a higher lows. This is a higher low. All right, and that is another higher low and another higher low and another higher low as the price goes to the upside. So this is the typical bullish market structure. All right, so this is the first example. So what we have here is an impulse leg. This is an impulse. All right, this is an impulse leg. All right, and this is a correction. Okay. So this becomes our correction here or retracement. So there is an impulse, okay? This is an impulse and we have a correction. We have a correction there, which is also commonly known as a retracement, okay? So you have a retracement right there. And you have an impulse. So there's an impulse and a correction. All right. So why is there a correction to form these higher lows? okay, which are also called swing lows. This is also called a swing low. All right. So higher lows may also be called swing lows because this is the price is swinging to the lower, okay? But why is this swing low happening? It's because buyers in an uptrend are waiting for a discount after this impulse move, okay? They are waiting for a discount before they can continue buying to the upside. So this retracement here, this correction here you see, is forming a higher low, which is also a swing low or a discount. This is a discount for people to buy this, to buy at a discount. All right, so this would be the higher low becomes a discount, or the swing low becomes a discount for buyers to place their buy orders here, typically looking to continue that move to the upside. So this is the typical bullish market structure. It has this component. It has the impulse move or the impulse leg, as some people call it, and there's a correction to the downside as it creates that structure. So there is also a break of structure here as it creates that swing low, then it breaks the structure again, creates another higher low. There's another swing, a swing low, another swing low, another swing high. So there is a swing low and swing high. This is the swing low, which is the higher low, and also there is a swing high. Okay, this would also be referred to as a swing high. So this higher high can also be referred to as a swing high. So this is the typical bullish. It has to form all these components for it to qualify to be a bullish market structure. So traders are typically looking to buy at the retracement, at the discount zones. These higher lows are discount zones. Why? Because there is that retracement to give a discount before you can buy. As you all know, when you go to the market, you are always looking for the best price, and the best price is always a discount price to buy. All right. So this is a discount zone. This would be a discount to buy again. This would be a discount to buy again at a retracement. This is a discount to buy again. All right. So that is in the market structure. This structure is generally an uptrend market. Okay. It's a generally an uptrend market. The price action prints candles upward. All right. So you will see that trajectory to the upside. The price action could create a higher highs and higher lows, and we are going to look at that. It's creating higher prices and higher swing lows, higher swing highs and higher swing lows. We are going to look at that. As it breaks structure, there has to be a break of structure to the upside as it continues bullish. All right. So typically traders are waiting to buy after the retracement or the correction. So at the swing low, that's where traders are looking to buy at a discount. All right. So in the real market, this is what you would see. This is a real market scenario that happened in retrospect in a bullish market structure. You have higher lows here, okay, and you have higher highs here. So there is also a break of market structure, and this is a swing low, okay, this is a swing high. As the market continues up, this is another swing high, this is another swing low, okay, creating that discount for buyers to buy and continue that trend to the upside. All right, so this is a typical bullish market structure. So this is how also it would look like right here. Okay, so you have the impulse here and then the correction there, or the retracement, giving us a higher low, a discount to buy to the upside. Okay, and when it breaks this previous higher high to form this new high, this then becomes a good pivot area where it was previously support. As I would show you, it was previously resistance, now turned support, because buyers buy at support and they sell at resistance. So you have here, previously it was a resistance, the price was resisted here, and it dropped to form a swing low at higher low and form the higher low price. And then with this new impulse leg,
it broke structure to the upside and formed a higher high. Okay, it formed a higher high. Okay, so this area here becomes the break of structure because there was a break of structure here to the upside. So with this next retracement, there was this retest here. So typically buyers are waiting for this kind of retest so that they can put their buys to the upside. So this area here, so this zone here becomes a pivot zone, a pivot. For those who remember their physics, there is a pivot and fulcrum, all right, where you have like a seesaw, where you have both resistance here, and now after the retest you have a support. So you buy at the support. You never buy at the resistance. You wait for confirmation, either to the downside or to the upside. All right. So that is what it is. So typically buyers are buying at a discount and at higher lows as they continue to the upside. And higher lows are usually retest zones. These are usually retest zones as they continue to the upside. All right. So they buy from here and continue to the upside.
So there is also the second one, which is a bearish structure. Okay, bearish market structure. This structure is generally a downtrend market. The trajectory is downwards. The price action has to create lower highs and lower lows. That means it creates lower prices and creates swing highs, which are lower than the previous swing highs. All right. It breaks the structure to the downside. Typically, traders are waiting to sell after that retracement or correction to the upside to sell at. As you know, you buy at support, that is at a discount, and you sell at a premium, that is at resistance. All right, so we'll be demonstrating that on the chart. And also the downtrend or the bearish structure also creates a break of structure. And then there is typically a retest before traders are looking to sell.
So something like this, all right? You have a typical bearish structure like this one. It also has an impulsive move like this, and this is also a correction move, creating lower highs, okay, and lower lows. Lower highs, lower lows. Okay, and as it continues down, it is a breaking structure to the downside. This is a break of structure as it continues to the downside. So this is the typical illustration of what a bearish market structure is like. And this can also be swing. This is a swing low. This is a swing high also. This is also a swing high. Okay, that is a swing low. Okay, as the market goes to the downside. The market is forming resistance levels where this becomes a resistance level. Previously support here, now turned resistance. So at the retest here, this would be a retest. Okay, this would be a retest area before a trader places their sell order to the downside to continue this trend. So you always wait for that retest of this previous lower low before you can place your trade or sell order. Why? Why at the lower high? It's because you are looking for a premium price. Premium means you are looking for a high price to sell at. As you know, when you are a trader or you are selling anything, be it a car, you are selling something, you want to sell it at the best price possible, and that is usually at a higher price. So you are looking to sell at higher prices and you are looking to buy at a lower price. So in this case, in the bearish market structure, you are looking for this retracement back here, okay, to form lower highs or a swing high, okay, or a swing high, and then you can consider selling because now you have got a good price, high price to sell at, okay. You don't typically buy a sell here, you sell at the swing high. All right, just like in this real scenario, you have a break of structure, the market is generally going downward. So this is a bearish market structure. So you have lower lows and lower highs, lower highs, lower lows, lower highs, lower lows. So you are looking to buy at the swing highs after retest. As you can see, there are retests there. If you look closely, there is this correction here, and then you can see the retest of that area of the break of structure. It's retesting this previous lower low here, and then before you can look for your candlestick patterns at lower time frames to continue that sell to the downside. And then the impulse, then the correction, impulse, correction, impulse, correction, impulse, correction, or retracement. So you are selling at the retracement. All right, that would be your impulse, and that would be your correction. This would be your correction. All right, this would be your correction or retracement. Okay, it can also be called this is a lower low. All right, that would be your lower low or your swing low. This can also be called a swing low. Okay, that would also be called a swing low, and that can also be called a swing high also. All right, or higher low. This is a swing high or higher low. Okay, and it can also be called, and this would be also your lower high, and this can also be your lower high, and that can also be your lower high, and that can also be your lower low, and that can also be your lower low. All right, as the market drops even further down, it creates lower lows and lower highs. So this is your typical bearish market.
And the third one would be the sideways consolidating market structure. As the name suggests, this market structure is just sideways movement. It moves sideways. There is no clear direction, either up or down. It is moving sideways. So the price action is confined between closely equal highs and equal lows. It may not be exactly equal lows and equal highs, but there is a ping pong kind of formation. The price is moving to the right in a sideways format. It's not moving up, it's not moving down, but it's creating smaller market structures inside, but in between what you would call like a ceiling and the floor. Okay, it's just bouncing in between there. It's not going above the ceiling, and it's not going below the floor. So that is a sideways movement. That is also a kind of market structure.
Let's say distance, and that is our support. Okay, and then you have this movement to the upside. Let's say previously the market was moving like this to the upside, and then you have the price reach this point and start consolidating for some time, moving sideways. It's not really creating new higher highs. It's just moving in between there, or higher low or lower lows. It's just in between there. Okay, so typically this kind of sideways movement is what we call a consolidating market structure. It's not really telling us where the price is going or indicating where the price is going. You are waiting for a break above, okay, and a retest of that resistance. All right, this is what you're waiting for. You are waiting for a retest of that resistance before you can continue buying to the upside. So this is what the scenario you are waiting for. All right, and alternatively, waiting for the price to break below here, return to retest this support level, which now turns to resistance if the market continues the downside. So these are the two possible moves that you will anticipate in a consolidating market. You are looking for this kind of moves. All right, guys. So here you would be looking to sell after retest, and here you'd be looking to buy after retest. If you are buying, you are looking for candlestick patterns on lower time frames like bullish engulfing candlestick pattern, or double bottom in the lower time frames, or 3 white soldiers to buy, to confirm your buy to the upside. Wait for that retest. Why is there the retest? The retest is to give you a good price, because there is this impulse. There is this impulse just created a higher high, higher than this previous highs here. Okay, it has to create a swing low. All right, it has to create a higher low before it can continue to the upside. All right, so in the sell after the retest here, you are looking for this retest, okay, as a premium price here to sell. You're waiting for that price to rise again before you can sell at a premium all the way to the downside. So the structure will be like that. Create this lower low, and then create a lower high, create another lower low here, and then another lower high, another lower low, and then another lower high, and then another lower low. Like that as it continues to the downside, as it breaks structure to continue to the downside. And even this would be a break of structure, the upside, as the price continues to rally, creating higher lows and higher highs to the upside. So that's how a consolidating market structure would look like. In this case of you can see what happened here in the real market. Okay, after that consolidation, all right, you can see this is a pure example of consolidating market. So what you would be waiting for here is a break above retest, then buy. Okay, this is what you'd be waiting, but you buy at lower time frames after candlestick confirmation. And you'd also be waiting for it to break below support and give you a premium price, okay, here, before you can go to your lower time frames to confirm that sell. So you'd sell here and then you'd buy there. Because this is a sideways movement, I wouldn't trade within here, but there are those who are trading inside here. Because as you can see here, as you can see here, this is a bearish structure, and then this is a bullish structure within this consolidating move. So scalpers will be making some money inside there, but I wouldn't really trade here.
Two major technical components of the market structure on the charts, okay? One of them is, you might have heard people talk about resistance. So what is resistance? Resistance is basically an area, okay? As the price of an asset rises, it breaks the structure, reaching higher prices, all right? Now, usually after rallying upward for some time, the price of an asset fails to break structure to higher prices. It starts forming relatively equal or even slightly equal highs, okay? High prices. When this price action happens, this zone of two or more slightly equal or even equal highs is called a resistance zone. It's also sometimes called a supply zone, and we're going to look at that. This basically means that the price has failed to break, okay, above. It has failed to break structure to form new higher highs and higher lows. All right, it has failed to break above that area, so that area becomes a resistance zone, or it becomes a supply zone, basically. So this also indicates a possible increase of selling pressure, as traders think the asset's price is high enough to sell. As you know, we wait for higher prices for us to get a premium price to sell at. All right, so everyone wants to go to the market and sell at a higher price. No one wants to sell at a very low price. All right, and buyers at the same time at resistance are hoping that the price will break above and form new higher highs and swing lows before they can enter for a buy. All right, so there is this indecision, especially at resistance, whether to buy or sell, but most traders will be looking to sell at resistance because the price has failed several times to break above. Several times it creates like a ceiling where the price cannot break above several times, and sellers are looking to short the market. And also at the same time, buyers are hoping that the market will break above and retest before they can continue upward. Let's go and I'll illustrate that for you on the screen.
Before you buy or sell at resistance. So in this case, you have a resistance zone, which is also called a supply zone. This is also called a supply zone. Why is it called a supply zone? Because sellers are looking to sell at this area because the price could not break above this area. So it also indicates that there is a lot of anticipation to sell at this area. So this is why it's called the supply. It's called resistance because this area has resisted the price from breaking above. There is a resistance to break above. That's why it's called a resistance zone. It's also called a supply zone. Okay? So when previously the market was moving in an uptrend, then it encountered resistance several times. So here you would be anticipating to sell, but you don't sell immediately. You wait for a change of character, some indication, okay, that the price will break structure and change structure from uptrend to downtrend before you can actually sell. Go and check out my videos about change of character, okay, that would indicate a possible reversal to the downside. That is when you would sell at resistance. There is also a second scenario at resistance. The trend could continue. There is a possibility of trend breaking above, okay, and there is that retest before it continues to the upside. So there is also that possibility. So you wait for this retest before, if this happens, if it forms a higher highs, okay, you wait for it to create a higher low here by the retest, a swing low. So at the retest here, at a discount, that's where you'll consider buying. All right? So that would be another alternative.
There is also another component of market structure called support. So support, as the price of an asset drops, it breaks the structure, reaching lower prices. So this one is the opposite of resistance. Here in a downtrend, let's say the market has been dropping, okay? It has been going down in a downtrend, all right? After falling for some time, the price of an asset fails to break structure to even lower prices. It fails to create lower lows and lower highs. That's what it means. It fails to create lower lows and lower highs, all right? It stays in one place and creates relatively equal or slightly equal low prices, thereby stagnating the price around the same area. Several times it fails to break below. It fails to break below several times. So it creates what we call a support zone or a demand zone. Why demand zone? Because most traders would be looking at buying at a support area. Why? Because the price has failed to break below to form new low prices. So they are looking to buy. Because there is accumulation, the sentiment of buying accumulates there, and most traders will be placing buy orders. So the buying pressure is greater at the support area. So that's what most traders are looking to buy. That's why it's called the demand zone. Okay. The theory is that the price has become low enough. It attracts buyers to buy at the support because it has been falling for some time. So it has become cheap or low enough to attract traders to buy. All right. In the other case of resistance, the price had become high enough for traders to sell. So you sell at a premium, you buy at a discount. So this is a discount zone at support where traders are attracted to actually buy. So it's called a demand zone. All right.
Yeah. Traders typically look for buying opportunities at support level. So you'd be looking for buying opportunities at a support level. It's also called a demand zone. All right. So typically traders are looking for this kind of formation where the price failed, like in this case, 3 times it failed to break below, all right, this support. And they are looking for confirmations, like in this case, the price moved, we see that bullish formation of a higher price, higher than this previous one. So there's a break above there, break of structure forming a new higher high there, okay? So this is a higher low, a new one which has been formed. So the structure has really changed to a bullish market structure or an uptrend from a downtrend to an uptrend. All right. So you would look for such confirmations at the support zone for you to be able to buy. All right. So this is a comprehensive short course that covers what market structure is like. In simplicity, that's what it's like. Okay. So this is all you need to know about market structure as a beginner or even intermediate trader.